Welcome to our commercial seminar. My name is Jenny Ching. I am your 2021 Education Committee Co-Chair. Today, our topic is 1031 Exchange and Opportunity Zone. A friendly reminder before we begin. All participants will be muted during the meeting. Please use the chat box for questions and the speakers will answer them during the Q&A session. Also, this meeting is being recorded and will be available on our YouTube channel later on. Now, let me introduce our speakers. Actually, we have two speakers today, Phil Atwan and Mike Hardy. Phil is a co-founder and the officer of Exchange Resources. He enjoys assisting and educating people about 1031 exchanges. Phil is featured at more than 150 educational seminars per year, hosted by real estate boards, financial planning organizations, escrow associations, CPA and EA tax groups, bar associations, and the real estate companies in the greater LA area and northward through St. Louis Obispo County. His reach extends across the nation. Industry-related professionals and real estate investors from New York to Seattle to Southern California call him to learn about the rules of 1031 and how to defer capital gain taxes. Phil began his career in 1982 in marketing and sales with a large title insurance company, transitioning to a 1031 tax defer exchange focus in 1998. He grew up in Pasadena and now lives in Whittier, where he and his wife enjoy their 3 children and 5 grandchildren. Now let's welcome Phil Atwan. Phil?
Jenny, good morning and good afternoon now, I should say. And hello, everyone. I'm very honored and humbled to be back with you again today. And we're going to spend some time discussing the aspects of the exchange in more of a commercial way. We're going to get into more of the difficult aspects of it, and I'm looking forward to going over those with you again. But we have a very special treat. We have Mike Hardy with us today, and Mike is with Cyrus OZ. Is that the name of your company, Mike? And I've worked with Mike for a number of years, and Mike has a lending background, but in recent years he's put together opportunity zones in terms of funds, and he knows a lot about these items. And sometimes, though I don't want to take any of Mike's thunder away from him, he knows how he can help the client in terms of tax possibilities for them to help them in the event that their exchange fails, or if they just want to get out of that end of the business and want to go into another aspect of it, of holding shares in an opportunity zone. Mike can also help them in that aspect as well. Since we're holding our questions to the end, Mike is going to be on for about 10 plus minutes with us. And the bottom line is that if you have any specific questions of him, he'll be happy to answer those questions at the end of his time. And you can just put them in the chat room so he can go ahead and address them individually. But without further ado, I want to introduce to you my friend, Mike Hardy.
Thank you, guys. Thank you, Phil. I appreciate the opportunity to come and talk for a little bit today. And so, guys, I'm gonna open this by talking about something that a mentor of mine taught me many years ago. We're going to cover opportunity zones today, something that's very, very unique in the marketplace. But I had a mentor of mine tell me something really interesting. He said, if you want to earn a living, customize. But if you want to build wealth, create a system. And create systems for everything. And so I've always thought that way for many, many years. And he said, think different, think bigger, play a game no one else is playing, and see a world that no one else is seeing. And so there's something that I do once a week on Sundays, an exercise called the General's Tent, which allows me just the space to think. And this is a number of years ago, but in taking the time to just think, I came across the opportunity zone. And it was really born out of my own pain in a sense, because I'm an investor and there's some, I don't like paying tax. Let's just call it what it is. And I was looking for better ways, and the 1031 exchange isn't always, it certainly is phenomenal, but it doesn't always work. And so I think that's why Phil wanted me to come and talk for a bit about this today. So interesting, the Wall Street Journal had an article that says the opportunity zone is the greatest tax break that you've never heard of. And I thought that was really interesting. And I was wondering, why have more people not taken advantage of the opportunity zone? And I'll unpack that in a minute. But all that to say, like in my mind, as I think as an investor, there's a couple of different disciplines and mindsets. There's making money, there's keeping money, and then there's growing money. That are three very different mindsets and different disciplines. And so on the growing money side, as we all know, if we're not being intentional to mitigate tax with our strategy, that growing money process can take a lot longer than if we had an efficient tax strategy. So enter the opportunity zone. And one of the things that I've come to find over the years is that when it comes to just different investment strategies, if there's a way to see the world differently and think in a way that others aren't thinking, that can give us a competitive advantage. So let me unpack the opportunity zone for you guys for a couple of minutes. When I first saw the opportunity zone strategy, it seemed almost a little bit too good to be true. And just to kind of cover at a 30,000 foot level how this works, it is something that was set up with the 2017 Tax Act and Jobs Act. And it really was created to be an incentive for investors to move funds into lower income areas. And it was really like a revitalization strategy to bring investment funds into lower income areas and then be able to have a pretty significant tax benefit. So let me unpack this from the investor standpoint, because that's the way that I approached this initially. So what I'm always thinking about, and I've been in lending for a long time, and I have a financial advisory background prior to being in the lending business. So this is kind of like a sweet spot for me in both of these different areas. But one of the things that I noticed is that to be able to move funds in and take advantage of this opportunity, there's really three different distinct advantages that the opportunity zone provides. Okay, the first is the deferment of capital gains tax. Okay, federal tax incentives, deferment of capital gains tax. That's number one. Number two is there is a step up in basis that is a part of, there's some timing rules to this, which I won't unpack now, but from this point forward, an investor can have a 10% step up in basis of whatever their initial basis is as part of being in a qualified opportunity zone fund. And then third, and the one that's most exciting, is the compounding of tax-free appreciation for a 10-year window. Okay, so as an investor, this was my aha moment, is if I have capital gains that I've realized, and this is realized, this is different from a 1031 strategy, because as we all know, a 1031 can fit very, very often, and Phil will unpack this for you, but there's sometimes where it just doesn't fit. So as an example, I'm going to give let me just use an example to illustrate how this works. And this could be a client that has potentially, you know, a busted or blown 1031, or someone, quite frankly, that maybe they just want to leave California, as an example. And they've got property, but they know, I don't want a 1031 exchange, but if I sell, my tax is going to be so significant. So I'm going to unpack this for a recent client just so you can see how this works. This is an individual that was ready to move out of California, had hesitancy to sell the property because of the capital gains tax that would be due. Property is going to sell for around $900,000 total. The basis on this property was about $500,000. So we have $500,000 of basis. We've got about $400,000 of gains. So as you all know, and this is not going to be a 1031 opportunity. So as you know, a $400,000 capital gains tax is going to be pretty significant. That's going to pull somewhere in the neighborhood of, you know, upwards of $100,000 out of that individual's control and possession. So here's how the opportunity zone fund works. An investor can take the gains of the sale, they can pull back their basis, the initial 500,000, they can take the 400,000 of gains and roll it into what is known as a qualified opportunity fund, a QOF. And that's what we've established about a little over a year ago, year and a half ago. Now, that 400,000 in the fund not only is the capital gains tax deferred, in fact, that tax is deferred up until through the 2026 tax year, and not payable and due until April of 2027. So now, of course, you can picture the compounding effect of money over time of 400,000 as opposed to 300,000 plus or minus in that specific example. And here's the best part, and this is the part that in my mind is really let's call it the magic of the 1030, or excuse me, of the opportunity zone, is as long as those funds stay invested in a qualified opportunity zone fund, which is investing in the opportunity zones, which you can Google and see where those zones are, though all of the growth that takes place on that can then exit the fund tax-free at the 10-year mark. Very similar to a Roth IRA in terms of thinking of distribution. So it's one of the very, very few places that allow for the strategy to move funds through the system. You still have to plan for paying the tax in 2027, and there's some techniques and strategies for that may not be a time on this call. But in essence, that's an example, or a simple example, of how an investor can have a significant upside from a 1031, or excuse me, from an opportunity zone fund. So I say all that to say this. I know that in this inventory, in this marketplace, what we're all looking for is what is a competitive advantage that we can have that can set us apart from the competition. And to be able to have I've actually had realtor partners that we've worked with that have been able to secure listings simply because they can actually have a conversation about this unique strategy that very, very few other people have heard of or are talking about. And I started thinking about this. Why are more people not talking about the opportunity zone? It was really bothering me because it really seems like this just amazing, unique technique that can be a huge advantage for investors. And of course, I have a financial advisor background. I was a Series 7 and went through the CFP program at UCLA. And I've been in lending for a long time. And I came to realize this, that financial advisors are not, because of the broker-dealer setup, they're not able to promote a qualified opportunity fund, a very small percentage. Just like when you look in the real estate world, commercial, residential, you're always going to have a small, maybe a 1 to 4% of the folks that are in a particular profession that really have the true expertise. The same thing applies in the CPA world, the same thing applies in the financial advisory world, the same thing applies in the lending and the real estate world. So it occurred to me, because it's not simple to have these products available, and the majority of CPAs, they don't, quite frankly, have the bandwidth. There's a small select subsection that actually have the depth and then get into the nuances here. That's one of the reasons that I think it's very under-promoted and underserved. So I see this, quite frankly, as a significant upside for investors that are maybe don't have the 1031 opportunity, or they're looking for a 1031 alternative. And the qualified opportunity zone fund, in my mind, is an ideal strategy to be able to provide an ancillary benefit. So Phil, I just hit 10 minutes. I can't see if there's questions in here. So let me see if I can get to the chat.
A question for you that maybe you can just, as you're looking at the chat box on the bottom, I have a question for you. What's the difference between an opportunity zone and an opportunity zone fund? And if you can discuss that amongst our attendees today.
Sure, absolutely. So the opportunity zone is the designated area that is actually, if I'm recalling correctly, each state decides where the opportunity zone will be, and that's where the investment needs to land for it to qualify for these unique tax advantages. In order for an investor to participate, it has to be a part of a qualified opportunity fund. It's a QOF is the initials, the acronym. So a qualified opportunity fund then handles all of the reporting, and is a qualified opportunity fund then invests in the opportunity zone. And so those are how those two come together.
So basically, you're buying a fund, whereas we're going to actually acquire the property itself, and you're going to be like the sole owner, or your LLC or whatever it is, then you would just acquire that property.
Right. So our fund, then there's different funds that have different strategies. We've taken the strategy of being in a space that is really just above the mom and pop investor and what they're typically able to do on their own, and below some of these more sizable Wall Street funds that have these big bite-size opportunities. So we're building out 100 units in the Inland Empire, and have a significant cash flow, and then we'll likely plan to sell that package to a REIT down the line, in addition to doing I've got an extensive network of realtors I've worked with for a long time, and we do a lot of fix and flips as well. So our particular fund, when an investor is going to move into a qualified opportunity fund, they have to become comfortable with the fund strategy. So there's two, in fact, Bill, let me make sure that this is clear. Two very distinct things. It's the tax advantage of the fund, and then the investment strategy of that particular fund. So the investor needs to get comfortable with the investment strategy. You can never have, my opinion, never a fund just for tax purposes. Some folks do. The investment has to be sound, plain and simple, first of all. And then we have the tax advantages that complement the investment. In fact, actually about half of our investors are cash only investors. They're not even leveraging I mean, they'll have gains, but they'll want to put some idle cash in there as well. So this is a fund, and anytime you're going to participate in the tax advantages of the opportunity zone, it has to be through a qualified opportunity zone fund. So thanks for helping with the distinction, Phil.
You're welcome. Actually, I see two questions in the chat box. The first one is, actually three now. Which age benefits the qualified opportunity
Age benefits.
funds? So in other words, is it a criteria of an age, like in your 60s or 70s, or can it be your 40s and 50s? What bracket tends to utilize this?
Got it. No, it's a great question. The range of investors we have are 30s through 70s, quite frankly. So this is not like a qualified pension plan where, at 59 and a half, you're eligible to withdraw funds. The age is irrelevant. Quite frankly, it's simply the timeline of having those funds invested for a 10-year window. And as long as there's a 10-year window of having funds that have been and it doesn't even have to be real estate. It could be Bitcoin. Those of you guys that have checked your Coinbase account and have noticed a nice run up and want to harvest some of those gains. It could be any gains, any capital gains can be placed into a qualified opportunity zone fund and still participate in these same tax advantages.
Another question that we have in the chat room is, how do you find a qualified opportunity zone property or a fund? Any idea on how to do that, Mike?
Right. No, and quite frankly, that's one of the reasons that my partner and I established this fund, is that I had a fair amount of investments on my own, and quite frankly was not happy with what I saw in terms of fund options available. So that was one of the reasons for establishing our particular fund. But we are really opportunity based, no pun intended. We need to make sure that we have 70% of our investments inside of the opportunity zone, and we've been given by the IRS code, there's a little bit of latitude, so we don't have to have 100% of the investment. But in terms of answering what I think the question is here, we have to make sure that we have a substantial improvement on any property that we buy inside of the fund. And so one of the rules that an OZ fund is required to follow is that there needs to be 100% improvement over the existing structural value after you back out the land value. So if land is easy math, if land is worth 100,000, structure 100,000, we need to add 100,000 in terms of our capital improvements in order to make sure that we're meeting the criteria. So I have a tax counsel that helps keep us on track. My business partner is a fund manager and very involved on the compliance side. So there's certainly some rules that a qualified opportunity fund needs to follow in order to be eligible. And we make sure that we're always stay on the very safe side of that line.
Good. There's two more questions in the chat room. First is there any way before you exit today, Mike, that you can go into the chat room and put your contact information, because people are already beginning to ask for that, how they can get a hold of you, like a phone number and an email address. So if that's possible, that would be really helpful. Here's the last question.
I'll type that in now.
Oh, good. And here's the last question.
Oh, I was going to say in my name there, I've got my email right there next to my name also. If those of you guys have, and I'll drop it in the chat too, but if you want to just send me a subject line, more info, I have a packet that I could send just to make it easy for you. So Mike at cyrusozfund.com. I just put it in the chat. And if you just put more info in the subject line, I'll know that it's from this seminar.
Yeah. And the last question Blanca is asking says, do we have to use all of the monies from a property, from a sold property, for example, sells for $960, can we buy a property for $750, or do we have to use all the extra funds in an opportunity zone or get taxed on the funds?
Great question. So you don't have to put any particular amount in. If you have a capital gain, you can move the capital gain portion into the fund. If you won't want to keep more of the cash, you can take half of the gain, put it in your pocket, pay the tax on it, and put half of the gains into the qualified opportunity fund to be able to participate in the deferment of tax. So there's a lot of latitude on what you do going in. And here's one key thing I forgot to mention, Phil, is that if you've had a 1031 that did not work and you had to take possession of the funds, you have a 180-day window after you've received possession of the funds to still then elect to take those gains and put it into a qualified opportunity zone fund. So there's a look back window. It's not like it has to be decided upon before you sell. You can sell your property, take possession of the money, and say, you know what? I really don't need all this cash. I really don't want to write this check for $100,000. I'm going to take these gains, put it into a fund, and as long as that's done in a 180-day window, you still participate in the tax advantage.
This is great information, and maybe another day, West San Gabriel Valley Association of Realtors might want to feature you to do an hour on this, because there sounds like there's just so much information and so much opportunity for investors to move their money into an opportunity zone, just the gain only, right? And keep the remaining balance for themselves, and ultimately not pay any taxes for at least a few years. If not, one more thing that I just thought of, just off the top of my head. After you go into the zone, the fund, if you're in it for more than 10 years, what happens to the gain that the fund will make for you?
I'm sorry, one more, I missed that, Phil. After 10 years? After
10 years being in the same fund, and the fund has grown in value, where the capital gain on what you made in the fund during those 10 years plus that you're in it, what happens then?
Right. At that point, you have the option to pull the funds out, or you can, of course, if the investments are running strong, you can leave them in the fund. There's a lot of latitude for the investor. This is, of course, now, quite frankly, even if you invest in the fund, there's a waiting period, but if you need your funds out for whatever reason, you can still take them out. You just have a taxable event at that time. So leave them in 10 years, then you can pull the gains out, and all those gains, then you don't have to pay those are tax free to you. If you want to let it ride, you can let it ride. We'll make a decision at that timeline of whether, what the investments look like and whether we want to continue. Most likely we will, but there's a lot of latitude from the investor standpoint. If they need liquidity, pull the funds out, pay the tax. If you want to let it ride and wait for the 10 years to have all of those gains be tax-free, tax-free. Here's the easy math, just for some simplicity's sake. If you have a 500,000 that go into the fund, and we're targeting, let's say it's 11.6% rate of return. then the funds will triple over that window of time, rule of 72. And so then you'd have 500,000 would be 1.5 million tax-free at the 10-year mark. Let's just say it's more complicated investment environment and it's a 7.2% rate of return. Then rule of 72, you would pull that $1 million out tax-free if it was a $500,000 initial investment. So we can get into specific scenarios later, but yeah, Phil, there's a reason the Wall Street Journal said it's the best tax break no one's ever heard of, because it's just not known with the majority of CPAs or financial advisors. And quite frankly, that's one of the reasons that we established the fund. So thanks for the opportunity.
Mike, we so appreciate your time joining us. It was worth every minute of it, that's for sure. And again, people can find you, Mike, at Cyrus ozens.com, which you've put into the chat box. And I know that you'll be happy to speak with everyone, or at least send them a package of information, and then they can get back with you on it.
Right. I'm happy to send info. If you just put more info in the subject line, feel welcome to drop a question in there. We can certainly have a part 2 on this. And Phil, always a pleasure to co-speak with you. Thank you for the work you do, and I appreciate your time, guys.
It's an honor to be affiliated with you, my friend. Have a great day.
Okay. Thank you, guys.
Thank you.
Take care.
And by the way, he just joined us from Tennessee, normally in Glendora area, here in the San Gabriel Valley, but he was in Tennessee for a big conference, and he joined us. So thanks again, Mike. I think he's gone now, but it's a pleasure to be back with you again. I want to talk some of the new things that are happening. I want to talk about some of the old we need to talk about. And I think we have about another hour to go. So that won't give me all the time I want, but it'll definitely get me going to share some information with you that I think is very significant. So welcome to our commercial advanced class, and let's start talking. And by the way, you may have noticed already, I don't know what happens, but when I'm on somebody else's feed on the Zoom, my picture tends to freeze periodically. I don't know why, haven't figured that out. But the bottom line is all I have to do is hit the stop video where my picture comes up, and then give it like 2 seconds, and then start it again, and I'm back live again like this. So I don't know which one's better, but I'll go back and forth as it happens. So I apologize for the interruption. Remember, today is still a big issue with vesting. Vesting continues to be an issue. What is the big issue with the vesting of a property? Must the vesting stay the same when you buy your replacement property? The answer is usually yes. But remember, the government has to see that the entity that's sold has to be the same entity that buys. But sometimes the vesting could be different, but you still have the same taxpayer. Let me explain what that means. If I decide to create an LLC and a couple of people on as shareholders with the LLC, remember, we begin an LLC because we want limited liability protection. If somebody sues us, we want them to only be able to take the property itself or any part of it, but not what our own personal assets are. We keep our personal assets separate from the LLC. That's why a number of good tax people recommend that you have separate LLCs for each individual property. Why? Because if you have 7 properties and you put all 7 properties in this same LLC, and somebody trips and falls and they're driving, and they're looking at all these billboards on the 605 freeway, on the 10 freeway, on the 210 freeway, on the 10 freeway, and it seems like any freeway that it has nothing but lawyers on there. You should sue for if you've been hurt and whatnot. So they hire one of these lawyers, right? And they find out that the property that owns or the property that's held is held by an LLC. And then they find out that the LLC owns several properties in there. Well, they see their payday go up and up and up and up. That means they can sue for more. And see, you folks, that's why it's not smart to put multiple properties in one LLC. It's more expensive, but putting individual properties in individual LLCs is usually a better way to go. Now, let's say the LLC goes to sell. The big question you're going to have to ask yourself is this an LLC with its own official tax identification number or EIN number or TIN number? Or does the individual have the Social Security number who owns the shares of the LLC as their Social Security number as the tax ID number for the LLC? If that's the case, and you have a single member LLC, or you have a husband and wife that own the property in an LLC that bears their Social Security numbers, then that's called a disregarded LLC. The disregarded LLC owns the LLC, but it has a Social Security number of the shareholder or shareholders, if it's husband and wife, of that property. And if they go to buy a new replacement property, you say, well, they have to buy it in the LLC, correct? Well, not always with a disregarded entity, because the disregarded entity bears the Social Security number of its owner. Therefore, for financing, they could acquire the property, not utilizing the LLC, but be able to utilize their name only for a lower loan percentage rate. So the bottom line is they could later on put it back into the LLC. The LLC maybe wasn't on the acquisition of the new property, but it did bear the same Social Security number. And when they put it back into the Social Security number and back into the name of that LLC, Social Security number stayed the same on the sale to the purchase, then ultimately that's a good 1031 exchange, because the seller and the buyer may have shown different on the names of vesting, but they were the same tax ID number. Remember, you're not a name, you're a tax identification number to the Internal Revenue Service. So they want to know that the tax paying ID sell and buy. And sometimes you can take it out of that name and put it in your, and then later on put it back into that name of the same ID, tax ID number. And as long as it's the same entity, the same tax ID number that sells and buys, you've got a good 1031 tax deferred exchange. So the vesting doesn't always have to be the same if both vestings have the same what? Social Security number or the same tax ID number. That's very important. Remember, as individuals, it makes it a lot easier. But when you have 10 common, everybody's got an undivided fractionalized interest in a piece of property. They can go separately. They could exchange together. It's whatever they want because they're tenants in common. They've got the freedom to go and do whatever they want. If it's under an LLC and you have two members that are not married or more, then you can't go separately because the tax ID number of the LLC, it's its own separate number. And each year, the LLC will hand out K1s to each investor. So therefore, you can't exchange separately because you don't own the property. You're just a shareholder. It's like a REIT. If you own a REIT, you own shares of stock for a particular investment, property, or even trustees. You don't own the property itself. Therefore, you cannot do a 1031 exchange. So the bottom line is, remember, you're not a name, you're a number. And you have to make sure with your CPA, and you got to be careful, you don't give tax guidance to your clients when it's in an LLC or a corporation. Sometimes even in a trust, because not all trusts are revocable trusts. Many of them are irrevocable. And sometimes it's a different tax ID number than the person who has. So my wife and I own our property in a family trust. Therefore, we make up that 85% where our trust is made up out of our Social Security numbers. So when we go to buy the replacement property and the lender won't lend us money for it, then we don't have to use the trust. We can just use our name. And then after we record the acquisition, we'll put the property back into the name of the trust. Same is going to be true in a lot of ways with an LLC if the LLC is what? Disregarded. It has the same tax ID number as our Social Security numbers. Limited partnership can't be done that way. A limited partnership has to sell and buy. So does the corporation. And so you have to be careful. You have to know what the vesting is before you even list the property. It's so important to find that out. Nancy, I saw you on the call today, and you can provide the property profile, at least the vesting information for the investor or for the realtor who's helping that investor sell and buy to see how they have ownership to that property. Very important, very important. Next question is, what happens if you want to take the property out of the LLC? Well, you can do that. And a lot of people told me this week even, well, we'll just dissolve the LLC, hold title as tenants in common, and we'll sell the properties and we'll go our own separate directions because we have multiple members. Well, there's a problem with that. You know what the problem is? The Franchise Tax Board requires that if you dissolve the LLC and hold title as tenants in common with different individuals, guess what? You cannot do a 1031 exchange until you season the act with the property you're going to sell in its new vesting for 24 months minimum. That's a problem. Most people are in escrow at that point, and they're not going to hold it for 24 months. So the bottom line is that what they can do is they can do either a swap and drop or a drop swap. And I want to show you the difference between the two. The drop swap says you take the listing, it's in an LLC, but you can't do a 1031 exchange in it because it has to be held for 2 years, for 24 months. So drop and swap is not a valid type of exchange. A drop and swap is for somebody who's thinking about separating themselves from the other shareholders of the property. They're going to dissolve the asset as tenants in common. Now, there's lots of ways of holding tenants in common. You could have it in your trust individually. You could have it in your LLC. You could have it in your name. Bottom line is that you have to hold it for 24 months before you enter into a sales agreement. Drop the title, hold it for 24 months, and then list it, and then sell it. But if that's not the case, and your client is got a buyer and they're ready to move, then they can do something called a swap and drop. This is when the LLC stays intact, and it's going to buy multiple properties for the different members. And then the LLC must hold those properties for 24 months. So you're going to be investor partners with these people for 2 years, one way or another, whether you're dropping, holding it for 2 years, and then selling and going your separate way, or for doing the exchange by swapping, holding it for another years in the name of that LLC, and then dissolving the LLC, and everybody gets their own property that they agreed upon back when they did the exchange. So be careful. They should be working with a really good tax attorney or a very knowledgeable CPA who knows a lot about this subject. Not very many of them know. And they call up people like me and other people that who do understand to get some knowledge on how a drop and swap and a swap and drop works, because it's just not the ordinary thing that they see in their tax practice. So you really do need somebody to talk with who pretty much gets this. Remember, some exchanges are not qualified, others are. And the question is, can I take my exchange funds into a property I just exchanged into and do improvements on it? So for example, if I'm doing a 1031 exchange and I'm selling for 1.5 million, and I buy a new property for 1.5 million, but I want to hold back some of the funds so I can do repairs and improvements to the property after I acquire it in my 1031 exchange, can I use my exchange funds to do that? The answer is no. You would have to do something called a build to suit exchange that we'll talk about a little later. But you cannot put money from your sale into the improvement or the repair of the property after you close escrow on that property. It has to be within the purchase of the property, and most people are not willing to do that. We'll show you how to do that in a build-to-suit exchange in a few minutes. But generally speaking, if you hold back any cash from a sale, even to do repairs to it or improvements, capital improvements, you will be taxed on the money that goes into the fixing of that property because it went into property after you already acquired it. That makes sense? Here's another one. How about if I do a 1031 exchange into a property that I already own where I want to put an ADU in the back so I can rent it out? Can I do that? The answer is no. You can't exchange in the property you already own. You see that's the second from the last bullet point on this little slide. You cannot purchase a property you already own. You cannot build on property you already own. Because once you take title to the property, that's it. It doesn't matter if it's one day or 10 years later. You cannot exchange and build on, and improve on property you already own. This question, the next question is, can I pay off a loan or build on property I already own, like my home or rental? The answer is no. We just answered that. May I purchase property that I currently own? No, we answered that. Can I exchange it to a leasehold interest? Oh, now that's another question. That's a good question. Can I exchange into a property that I'm not going to technically own, but I'm going to own a leasehold interest in that property? The answer is if the leasehold that you're acquiring has in its lease a 30 full year lease, or with the lease and its extensions total to over 30 years, then the IRS recognizes that lease as real property and you could exchange into that. Believe it or not, you can exchange into a leasehold interest if it's 30 years or longer. The opposite is true too. If you're selling property and you have a leasehold interest in that property, you don't own the property, you just own the lease, and you're part of that, and that lease has at least 30 years left on it with its extension, you can sell that leasehold interest and do a 1031 exchange, buy property that you will personally own, and the government will allow for that. So that's a big deal. You don't see a lot of it, but it does happen. Here's a big question that a lot of investors have been asking, especially in the residential end. We know that like-kind property means the sale of investment property, the purchase of investment property. That we already know. But here's the question. Can I convert it to my personal residence? You know how many times people ask me that? I get that question multiple times a day. People wanting to convert an exchange property that they're selling to rental to go into another rental. But their goal is not to keep it that way. Their goal is to move into it. Does the IRS allow for that? Are you ready for the answer? There's 3 answers to it. You ready? No, maybe, and yes. So which one is it? It's actually all 3. Let me show you why. First thing is, never answer that question to your client. It's a tax question. If you have a license in California to give out tax advice and to do tax returns, then you could answer that question. But if you do not have a license to give out tax advice in the state of California, I hope your insurance is paid for, because the bottom line is that you cannot give them advice to move into a property that they exchanged into. It's illegal, so be careful. But let's talk about that question. So number 1, when you do an exchange, you have to buy a like-kind property. Like-kind doesn't mean commercial to commercial or residential to residential. It means you're selling investment real estate and you're going to buy some kind of investment real estate. So you have to buy that property with the intent to what? Hold for investment, just like it says right in the middle of the slide. It has to be the intent to hold for investment. But what happens after that? What if something changes? Some kind of a change that you did not anticipate, unexpected, was unplanned. What can that be? Maybe something like a illness, some kind of medical condition where you had to convert the property into a personal residence, something that was not anticipated. What happens if there was divorce, like a family change, or death of a spouse? Something where you had to move into the property because of this family change that was unanticipated. What about a financial change? Something, a downturn personally, and you had to convert that property to a personal residence. So the bottom line is that there are opportunities to convert the property into a personal residence after 2 years, of ownership after the 1031 exchange. Okay, but here's the bottom line. The bottom line is you cannot exchange into that property and then move into it after 2 years with the mindset that you were going to do that in 2 years. Because if the government figures it out, they're going to go back and disallow your 1031 exchange. Now, people tell me all the time, they say, well, I know people who have done that, who've done 1031 exchanges, converted the property and 2 years later to a personal residence. They didn't have any reason outside of they just want to live in it for a while and not have to pay the taxes and then sell it and maybe get a part of the 121 principal residence exclusion on that, right, for your primary residence. Well, let me ask you a question. Have any of you ever driven through a stop sign where you rolled and you didn't completely stop? Or did you ever go on a speed limit where it was 35 and you drove 45 or 50, or on the freeway at 75 or 80 or more? Why didn't you get a ticket? The answer is because you didn't get caught. And that's exactly what's happened in the past with so many people. I don't know if you know this, but the IRS recently has spent, with a B, over $1 billion in new data mining software. What they're trying to do is catch people who've been cheating the government, who've been not wanting to pay taxes that they were supposed to pay taxes on. And guess what else they're looking at? This right here. Did they just do an exchange just recently in the last few years? Why have they converted it into a principal residence? The IRS isn't really meeting with people anymore on audits. They're doing it on Zoom and on the internet. So they can just meet with you like this. And you're going to have to defend yourself or have your CPA defend yourself that you had no intent to convert the property and that something changed that was unexpected or unanticipated or unplanned. So be careful. Don't give this kind of advice to a client. You're giving them tax advice. If you're going to do that, you might as well guess what their gains are and do their tax return and tell them how much money they're going to make in the stock market, all of which are illegal, right? So don't do that. You can't give them that information. So be careful, be careful, be careful. Here's another question. What about relatives? What about related parties? How is the government feeling with that? And does that affect the 1031 exchange? I could sell a personal residence to a relative. I could buy them a personal residence from a relative. The government will allow for that. But the question is, does the government treat it differently when you're selling or buying from a relative in a 1031 exchange? And the answer is they sure do. And here's how. First of all, what is a related party? A related party is a person who is your relative. They have a straight lineage descendant line. It's like a grandparent to a grandchild is under the same lineage. Married people to each other are now officially married. They're related to each other. Brothers and sisters and siblings are considered as related parties. Your children are considered as a related party to you. Your parents are considered as a related party. It's not the way the lending community describes it, because remember when we had all those short sales and foreclosures, they said you couldn't buy from a related party and they thought that your second cousin was a related party to you. That isn't the IRS's description. The IRS is a straight line lineage descendant. So the question is, could I sell to my brother or to my grandparent or to my children? Can I sell a property, and when I'm doing a 1031 exchange, to a relative of mine or a related party, which is the same thing? The answer is yes, you can. However, the bottom line is that if you sell to them, that person who buys your property must hold it for 2 years after your exchange is finished and you buy your new property, your 180 days is done. Then there's a 2-year hold period for the person that you sold your property in your exchange. Consequently, the person that exchanged also has a 2-year holding period. That property cannot be exchanged or sold in any way for a minimum of 2 years, 24 months. If either party sells those properties and closes escrow before the end of that 2-year period, they violated this related party rule. The IRS will go back and assess the taxes on that sale to the person who did the exchange. So be careful. If you're going to sell to a related party, they have to hold it for at least, I'd say, 2.5 years. That's a better way to go. Secondly, can I buy from a related party? So if I'm going to do a 1031 exchange, and let's say Nancy is my sister, and I want to buy a property from her, it's her primary residence, she wants out, she wants this little small condo now. Could I buy my property, her property, as my replacement property in a 1031 exchange? The answer is no. You could never buy from a related party unless the related party is also doing a 1031 exchange. So both parties have to be exchanging. Now, Nancy cannot do a 1031 exchange because she gave me her principal residence or a second home. Second homes and principal residence are not allowed in a 1031 exchange. Therefore, I could not buy her property as a replacement because she's a relative. And she can't exchange the property that she's selling to me because it isn't exchangeable under Code Section 1031. So remember, be careful when you're working with relatives in a 1031 exchange. Remember, there's a 2-year holding period. Now, if you buy the property and you hold it for 2 years, and then later on you convert it because you had a legitimate reason after year 2 of ownership or any time after that, and then you live in it for 2 years, can you take the 121 principal residence exclusion on the sale of that property? And the answer is no. You have to hold it for a minimum of 5 years, at least 2 years that you've lived in it, and then 2 years or 3 years before that, or 2 years that it was a rental, and then 3 years that you've lived into the. You have to hold the property for a minimum of 5 years to qualify for 121 principal residence exclusion. That's where you get up to $500,000 if you're married, filing a joint return with your spouse of the ownership of the property, or if you're single and you get up to 200. Now it's up to. It's not the whole 500 or the whole 250. And you'll see that in a second. You have to live in it for 2 years, right? And you know you had to have rented it out for a minimum of 2 years, but something changed, like we said earlier, where you had to convert it to a principal residence. This law changed in 2004, but then later on in 2008, Congress created something called the Housing and Economic Recovery Act of 2008. This went into effect in 2009, and this is what they said. When it comes to these conversions, if I can find my mouse here, there it is. They say that if you convert a property that you already own, whether it's a rental property or a second home or a vacation home, and you decide to move into that property and then live in it for 2 years minimum, and then you go to sell it, you're no longer going to get up to $500,000, and you're no longer going to get up to $250,000 anymore. because Congress created this Housing and Economic Recovery Act. Now, I don't think that's a recovery act. I think if anything, it's a tax act. Because what the government will do in that situation, if you converted a property that was a rental or a second home or a vacation home, and you moved into it and you lived in it for a minimum of 2 years or longer, then they're going to have your CPA go back to when it went into effect back in 2009, January 1st. And they're going to look at all the time that you did not live in this property, whether it was your rental, your second home, or your vacation home. And those are called disqualified years. Then they're going to look at the 2 years, the 3 years, or however long you actually did live in it. Those are called qualified years. They will compare the number of years of disqualified years beginning 2009 and the qualified years that you lived in. They will come up with this equation and then come up with the percentage of the $500,000 that you get, up to the $500,000 if you're married filing a joint return, or up to the $250,000 that you get. So if you lived in it half the time, you may only get half of the $500,000 or half of the $250,000. If you only lived in it maybe 20% of the time, you may just get 20% of the $250,000 or 20% of the $500,000. You will pay taxes on the rest. It's not a good scenario, folks. This is a recovery act for the government to raise money, not for the investors who have moved or converted a personal, like a second home or a vacation home or a rental that they've owned. So be careful, be careful. Don't tell people by automatically living in the property for 2 years, they automatically get the $500,000 or the $250,000. That's just not true anymore. And that wasn't true beginning January 1st, 2009. That was what, 11 years ago, 12 years ago? So be careful, 11 years ago. So be careful, be careful, be careful what you tell your clients in terms of exclusion and what tax breaks they get. Could I combine the 1031 and the principal residence exclusion, which is the 121, in a single sale? So let's take an example. Let's say your client has owned a primary residence, let's say for 30 years as an example. They bought the property when they were young. After they got married, they had their children, they raised their children in the house, and now the children are pretty much all gone. So what happened is that after the children moved out, they've got this huge house that they bought for $300,000 that's now worth $3 million. So it's worth a lot of money. But since it's their primary residence, all they get is the 121 principal residence exclusion. Well, let's just do the math. If they sell it for $3 million and they bought it for $300,000, of course, we're not going to put in the capital improvements and all the other things that they did to the property and the closing costs. Well, the difference is what? Between 2.5 and $2.7 million of gain. You've got a huge tax bill because the bottom line is all you get off of it is $500,000. That means you're going to pay taxes on roughly $2 million or more. That's going to be a huge tax bill. Let's talk about that. Did you know that the federal government now allows that you can convert your principal residence into a rental? Move out of it, rent it out for 2 years. After the second year of moving out, you completed 2 full years of rental, you now list and sell the property. You sell the property, you can now do a 121 residence exclusion of the $500,000 of gain, but you still own at least what? Taxes on $2 million? And you can do a 1031 exchange on the balance because the last 2 years, your former principal residence has been a rental. The government allows us to do both. They made that happen on February the 14th, which is Valentine's Day. So the government gave us a love gift on Valentine's Day, all the way back in 2005, where you can convert your principal residence to a rental rent it for 2 years, sell it, do a 1031 exchange on the property, except for the 500,000 and the 500 of exclusion you put in your pocket. Isn't that great? It's a wonderful way to go, and the government will allow for that. Also, we've talked about this in the past. I just got to bring it back up because it's a very real thing. Why? Because based on my calculations, and remember, we're one of the largest independent exchange facilitators in the country, and we're based out of California, which I don't know why this picture keeps freezing on me, and I apologize, but I'll just keep doing this, and it seems to freeze it. Based on my observation over the last year, 25% of my client base left California. If you haven't noticed already, many people are fed up with California, with the politics, they're fed up with the taxes, and they're fed up with the way they're treating landlords. Then a landlord was the lord of the land. Today, the tenant is the lord of the land. The tenant doesn't have to pay. They have so many rights that the landlord are the victims in some situations. So what's happened is people are tired of this and go to other states. And I've watched them because I've helped them do the 1031 exchange into places like Idaho, states like Idaho, states like Arizona, Nevada, Texas, Tennessee, places like Florida, and there's an influx of people who are leaving states like ours and New York in these heavily taxed states. They're buying and relocating their properties out there because the taxes are killing them, and the government's killing them with all the regulations, not to mention rent control. So what happens is, well, the question people ask me, what happens with the state of California? Will they also allow me to do a 1031 exchange? I know the feds will, the IRS will, the state. And the answer is yes, but California, you might know if you look at our flag, if you look at our mascot on our flag is the California grizzly bear, right? I think it's the grizzly bear. It's a bear for sure. And if you remember, the bear has a claw. Well, California, with its bear, has something called a clawback rule. What is that clawback rule? Well, the government is saying that if an investor chooses to exchange out of the state of California, and the state wants to keep track of that new property, because if that property is eventually sold, the state wants to claw back the tax on the capital gain when they left the state, and it's legal. So the clawback is utilized in the state of California. So should you exchange out of the state of California, don't get nervous. It's actually a good thing for a lot of investors these days who are choosing to do that. And frankly, I'm getting a lot of that right now in 2021 as well. You have to file a form. It's called 3840. It's in red on your screen. Allows the state to keep track of the sale and until the that replacement property is disposed of in a taxable sale. Now, what does that mean? That means if I choose to sell that property and I buy, let's say, a replacement property in Nevada, okay, and I buy a rental there and that grows in value and it produces income, and I'm really happy because the state is no longer my enemy. Well, as an investor, what happens is that I have to report every year that I still have the property. It's just one form. It's not that big a deal, but it has to be filed every year. If you don't file it, the state claws back. So you have to file it. As long as you don't sell it, you're fine. If you do sell that Nevada property and you decide to do another 1031 exchange and you go to the state of Montana, that is not a taxable sale of that property in Nevada. That means you still have to file the form each year, the 3840, to the state of California, but they claw back on you because you did another 1031 exchange. You can keep doing exchanges, and the government will let you do that. And California then cannot claw back until you die. And if you had to set up a trust or something, or a nice way that you planned it with your estate planning attorney, with the way you had vesting to the property, then you get a stepped up basis, and California gets nothing. Isn't that great? So remember, the California clawback is the only thing you have to look out for, that if you ever cash out in a taxable, California is allowed to come back, claw back their part from the time you left California with that property, and those taxes will be due for them. All right, that's very, very important. Before I start talking about reverse exchanges, I know the time is moving by quickly, and I want to talk about a couple of other things before I get to these types of things here. I want to share some of the things that are happening in our industry with you today. I want to go to, oops, I will get to it just a second. There it is. Let's say I bought a property once upon a time, $100,000. That's item number 2. All right. If I bought the property for $300,000, but over time it appreciates, now it's worth $1 million. Well, your CPA is going to figure out what the capital gain is on the sale of that property. The capital gain has nothing to do with how much equity you have in the building. The capital gain is based on a formula that looks like this, but it's more complicated. This is a simplistic way, not for you to practice this, but to figure out quickly what the possible gain could be. And generally speaking, you look at number 2. Number 2 is actually first. You look at what you paid for the property. Well, let's say you paid $300,000 for the property. And let's say during the course of the time that you own the property, you put in $100,000, let's say, into the property, that raises that purchase price, which is also known as, important to remember, your adjusted basis. So basically, the sales price minus the adjusted basis and all these other items in number 2 will be factored in by your CPA, will determine what the capital gain is. What happens when you sell the property with a capital gain? By the way, if this is my primary residence, then they will take, since I'm married, filing a joint return, if I qualify for the whole $500,000, they will take $500,000 off the $700,000. Then I will pay tax on $200,000 because now I have a capital gain of $200,000 because I was married, filing a joint return, and this was my primary residence the whole time. It wasn't a conversion like we talked about earlier. If I was single, they would take off $250,000 off the $700,000. That means I would owe taxes on $450,000. Remember, please do not try to practice this for anyone. Have the CPA, have your client CPA do that, because it's very, very important that they determine what the actual capital gain is, because there's lots of things that are going to be included, like closing costs, depreciation, capital improvements, and other things. So it's so important that your CPA do this for your client. Now, what do you pay in taxes? If it's your principal residence and you come up with $200,000 of capital gain, well, then you would pay up to 20% of your capital gain, or 20% of the $200,000 would be taxable as capital gains taxes. And that's what you would pay if that's your primary residence. But if there's no 500,000 or 250, because it's not a primary residence, it's a second home or a vacation home or a rental, you pay the entire amount. Number 2, regardless of whether you're selling a principal residence, a second home, or a vacation home, the government also charges you, because when they passed the Affordable Health Care Act, they jacked the capital gain an additional 3.8% to pay for the healthcare tax. You remember, that's the one that Nancy Pelosi said, let's just read it, let's pass it first, then we could read it and understand it better. Well, that was in there, and it jacked up the tax of the sale. whether it's a principal residence, a second home, a vacation home, or a rental property. Number three, the state of California currently wants between 9 and 13%. 13.3 is the high end. Capital gains tax. It's actually not a capital gains tax, it's ordinary income tax. And then if it's a rental property, you are allowed to depreciate. Well, then you would pay a 25% depreciation recapture tax on top of all this. This is what you pay when you sell the property. Now, just in case you haven't heard, the White House in Washington, D.C. is handing down a new tax proposal to Congress. It's supposed to be released sometime this month. We'll see if it comes out in time. But in this, they're going to make a big change. If you look at number one, the 20% tax, they're no longer going to call it a capital gains tax. As long as you've made $400,000, including the income from that property or more, that 20% tax is going to change to ordinary income tax. And they're going to raise, they want to raise the ordinary income tax rate, the bracket, to 39.6%. Did you hear what I just said? 39.6%. That means your client is not going to pay 20%. They're going to pay a lot more if this passes through Congress. Congress has to make the decision. And if you make $1 million or more and you have a capital gain, it goes to ordinary income at 39.6%. They really want to raise the taxes because I guess they're handing out trillions of dollars of relief. Anyway, the bottom line is that is a proposal in the new tax proposal that the White House is handing down to Congress. Guess what? We're going to be fighting this. CAR, NAR, the Exchange Federation of Exchange Accommodators, that's us, the California Land Title Association, the American Land Title Association, and the American Association as well. Everyone's going to be fighting this because it's going to slow down the industry. It's going to cause recession. And if it causes recession, guess what's going to happen to business? And guess what? When recession hits, they don't collect as much tax revenue because people aren't working. They aren't making money. And when you make money, you pay taxes. And when you pay taxes, you go out and you spend. But you see, it's going to be reduced if they decide to do this. Number two, last year, because of COVID, California has been running deficits in red. If they tell you they're fifth largest economy in the world and all that, look at the last year. Look at the reportings that have been made for California. We're losing money, folks, and we're still spending like there's no tomorrow. So what happens is California last year proposed that the state tax go from a high to 3.3 up to 18%. Well, guess what happened? The state legislature in California couldn't agree. So they ran out of time and the bill failed. There's a word on the streets that California is going to reintroduce this bill to raise that to 3.3. And by the way, California is already the #1 tax state in the country. Now, maybe they can't get it to 16. Maybe they'll get it to 14 or 15. Who knows? Maybe they will be able to get it to 16, but not touch 18. The whole point is taxes are going up. It's going to affect your client's sale of any real estate. If it's over on their principal residence, if it's over their exclusion amounts, on their second home, their vacation home, and certainly if it's a rental or investment property. Next, that's proposal number one, the raising of taxes on the sale. Will I eventually pay the taxes? The answer is yes, if you don't do a 1031 exchange and it's been rental or investment property. When you do it, when you have rental or investment property, you for the capital gains tax, 100%. All those taxes I just showed you, all four. And the bottom line is that this exchange allows you to continue to keep rolling into other properties later on down the line if you want to get out of that property and go into something that's going to be better for you or your client. Now, proposal number 2 from the White House is to eliminate the 1031 tax deferred exchange. Now, I don't know if you know this, but do you know it's our birthday? Our industry is 100 years old this year. Congress introduced the 1031 exchange back in 1921. And since it's 2021, it's 100 years old. Well, guess what? That tax deferred exchange is still going strong. And many investors utilize it for the purpose of growing their portfolio to create better cash flowing properties, properties that are diversified so they can appreciate more as values go up, as you know, and then ultimately that they can buy up and create additional tax write-offs because the government's killing them on the income that the properties generate. That's why a lot of people are leaving the state. What happens is that if they eliminate the 1031 exchange, your clients will most likely choose maybe to rethink selling the property and just sitting on it, which means recession. It will slow down the economy. Keep in mind that real estate, what you sell, is a huge revenue to the federal government and to the state of California. So the bottom line is to eliminate the exchange is not a good idea. Our association plus CAR plus NAR and all the other ones that I mentioned before are going to be standing with us and fighting Congress to make sure that Congress does not allow the 1031 exchange to be eliminated. This is important. Remember that we just had the previous page of them raising the capital gains into ordinary income to 39.6. Well, guess what? I was on a webinar with all our lawyers and with all our industry, and we're feeling like that even though they're asking for 39.6%, they're not sure that Congress is going to let them do that, and they may just up the capital gains tax from 20% to maybe 27%, which is still a huge hit. It's not like the 39%, but the bottom line is it's still a significant hit. We also feel that this is a winnable war to preserve the 1031 exchange. This is not the first time anyone from either party has tried to eliminate the exchange. Over the 100 years, it's been challenged a number of times by the president, whoever that was at that time, or Congress. We've been successful showing them that the IRS is able to collect more revenues for the Treasury Department by having this exchange because of all the jobs and the income and the tax revenues this provides. So the bottom line is, we hope you'll stand with us on this. But that's just number 2. The third proposal that's being handed down from the White House is to eliminate the stepped-up basis. You know what the stepped-up basis is? That's when there's a death of a spouse and it goes to the other spouse at the market value at the date of death, or it goes to the heirs at a market value at the date of death. So now they don't have the burden of taxation. They can sell the property and keep the gain because there is no gain at that point. The gain is wiped out. The White House wants to eliminate that. Now just think about it. How many people are on reverse mortgages just today? Think about it. They live in a primary residence, the elderly, utilizing their equity in their building. The commercials on television and heard them on the radio and seen them on the billboards. There are more and more people to do reverse mortgages to take money out of the equity that they can live on until they die. And then their heirs get a stepped up basis on the property. So the sales price minus whatever is owed through the reverse mortgage, they don't pay tax on that money. Well, if they eliminate the stepped up basis, not only will these people be inheriting their parents' properties with equity being depleted, but they have to pay the whole tax on the capital gain. What happens if it's upside down? They don't even want the property because it's going to cost them money just to sell it out of their pockets. This is serious. We are fighting with NAR, CAR, and the rest of those organizations that I mentioned to you, that we preserve this. This is this would cause a recession just within itself. A slowdown in the economy of real estate, which pulls the economic train of the US economy. It's dangerous. And it's really not a wise move. It's going to cause recession and another slowdown. And with the government spending money like there's no tomorrow, it doesn't look good. So we think we could win this as well, but we're going to need you to make sure that you stand with us, with the exchange companies, and with CAR and NAR, which you happen to belong to, and all the other organizations that we mentioned earlier, to stand up, because we don't want to see the economy slow down in the area of real estate. Why? Because it brings in so much revenue to the US government and the US Treasury Department. Okay, how are we doing on time? We have about 10 more minutes left. I has gone so fast today, but I always enjoy being with you. And there's other information I want to comment on. I've had a lot of people ask me lately, let me go to it. What is boot? Is it allowable? What is cash boot? What is debt relief boot? Is it allowable? How much is it allowable? Let me show you what you have to know when you're doing a 1031 exchange. And this slide is a good example. Let's say you're selling a property for $1 million. All right. Did you know that the federal government allows you to back out the recurring closing costs out of the sale? What is that? Those are the one-time costs that you pay, that the seller has to pay to sell the property. Real estate commissions, escrow fees, title company fees, transfer taxes. All counties in California pay $1.10 per thousand on a transfer tax that the seller pays to the county. For every $1,000 of sales price, it's $1.10. That can be pretty hefty depending on the value of the property. Some cities have a transfer tax. That city transfer tax, by the way, in most cities are far above the county transfer tax. LA is $4.50. There's a number of cities who implement the transfer taxes or are considering the transfer tax. So what else is considered as a cost to sell? Is property taxes? No, that's recurring. That's something that you pay on an ordinary income basis. It's not a non-recurring cost to sell. HOA fees? No, that's recurring. That is not a non-recurring cost to sell. Insurance? No, that's recurring. It's not a non-recurring cost to sell. What about maintenance to the property that you had to prepare the property for to get it prepared for sale? No, that's maintenance. That's ongoing. That's recurring. It's not a non-recurring cost to sell. There's one other cost of sale that a lot of people don't think of. You know what that is? The buyer, via contract, asks the seller to either credit them or fix something that they found in an inspection that's wrong with the property. And that could be a lot of different things, or propose things that look like they're wearing out, that they're going to ask for a new credit for a new air conditioning and heating system, HVAC, or maybe it's for other issues like landscaping or deterioration of paint or wood rot or plumbing or electrical to upgrade the system. And if the buyer requests for the seller to do this via contract, via the offer or a counter, and the seller agrees to pay for that or to credit the buyer for that, technically that's considered a one-time cost of sale. One-time cost of sale. You know what that means? That means $70,000 under number 2. If I sold for $1 million and my total non-recurring cost of sale is 70,000, that means my new purchase price of my new property has to be at least $930,000 or greater. People say, well, wait a minute, time out. I thought a 1031 exchange was equal or greater what you sold for. It is, minus the non-recurring closing costs. Now, you don't have to tell your clients about number 2. You could if you want, but you might get into too much discussion of answers that you won't be able to have. So if it's easier, just tell them buy for $1 million or more. But technically, in this example, 930 is the minimum acquisition price. That's number 1. Number 2, so let's say I use the 930, but I keep part of the cash for use. You know, like I want to repair the property after I acquire it, right? In a 1031 exchange or whatever. The bottom line is that's boot. It's got to go into the purchase, not into the property after the purchase, but into the actual purchase of the property. All the 930 must be used. But what if I have loans on the property, existing debt that I have to have paid off by the title company at the close of the sale? Well, then let's just say you have a first, a second, a line of credit, HELOC, whatever. The total mortgage payoffs of the sale of this property, number 4, is $400,000 in red. So the cash from the sale minus the non-recurring closing cost leaves me 930. The 930 minus the payoff is 530 that's left over. That's all I have left of cash. At the close of the sale, that money goes to the accommodator, and that goes into the acquisition of the replacement property. All of the 530 must be used. If you don't use a part of it, it's called boot. It's taxable. It doesn't disallow your exchange. It only allows your exchange to be good except for the money you keep, and that part that will be taxable. The rest of it is good. But you said a minute ago you have to buy for $930,000. I did say that. And guess what? The bottom line is that you have to replace number 4. The mortgage must be reborrowed when you go to buy the new replacement property. If you don't borrow the whole 400, you borrow only 350,000, you pay taxes on $50,000 because you didn't borrow the amount of debt on the purchase that was paid off on the sale. That is so important. Some people ask me, but can I substitute the loan with new cash that I could bring in from my own personal savings account, my own pocket, whatever? Can I bring in new cash into the purchase to replace the loan? The answer is yes. The government will allow you to do that. So if you want to bring in $300,000 of cash, that means you have to borrow now $100,000 because you paid off $400,000. So new cash, 300 plus plus $100,000 in a loan equals 400. Debt replacement, the government is square with you on that, and as long as the remaining balance of the $530,000 that the accommodator is holding for you into the purchase of the replacement property, ladies and gentlemen, that's a good 1031 tax-deferred exchange. So that's what we mean by boot. You have to replace all the cash. You have to replace all the debt. So technically, the only thing you don't replace is the number 2, the non-recurring costs to sell. Well, it looks like our time is almost up. So I'd like to end today by going to, let's see, a last slide here. And I know we were all over the map here, but I have a number of marketing letters that I can make available to you. They're for people. You talk to somebody like Nancy, who will give you a farm package of the investors who own these properties for at least 10 years or longer. You want to qualify it with people who have equity in the building for 10 years or more. That means there's capital gain in the building. And you can start talking with them about items like your income. How do you reposition the equity in the property to go into other bigger, better properties that have more front doors that'll pay you rent, whether it be commercial or industrial? What a chance to re-leverage by selling and buying and doing a 1031 exchange. How do I create more appreciation? The answer is by doing a 1031 exchange. What happens is that you can take the equity of the building and then redistribute that equity into more properties. And as prices go up in the future, all the properties will go up, not just the one that had all the equity in it. That's how you re-leverage to make more money, to create more equity, to create more income producing power. Depreciation, that stays flat for 27 and a half years if it's a residential building, if it's a commercial building for 39 years. But the beauty of doing the 1031 exchange is if you buy up, you create additional depreciation, which means your client now has additional tax write-offs to offset the rent that they're receiving from the tenant. What other types of properties can I go into? Well, earlier you asked me to mention, somebody mentioned to talk about a DST. A DST is something that is a good option that some investors have chosen to go into. That's when you buy a Walgreens pharmacy or a Starbucks shopping center or a Trader Joe's shopping center, but you can't afford the whole thing. But you buy a small little part of it, like about a 6% portion of it. You become like a tenant in common with a group of other investors. The government will let you do that through a DST. DST stands for Delaware Statutory. Statutory meaning like law. Delaware like the state. Delaware Statutory Trust. And they call it for short DST, Delaware Statutory Trust. You can acquire property that way, and there are a number of people who sell those. Some are good, some are not so good. If you need a good referral, I'm happy to give some names to you. Shoot me an email or call me, and I'd be happy to share some names and numbers with you of some people who I think are pretty quality people that I've known over the last 20 some odd years who've been doing this as long as the government has allowed it to be done. Did you know you can go into triple net properties? You can get out of the management business by going into DST or buying a McDonald's property where the McDonald's becomes your tenant, or Starbucks becomes your tenant, or maybe Walgreens or CVS becomes your tenant, or maybe the 99-cent store or some other big Dollar General who own a number of properties nationwide. It won't be in and out because they own all their properties out 100%. But the bottom line is you could acquire any kind of large properties that you don't deal with anymore. They're triple net. You don't pay the properties. Why? Because Walgreens pays for it. You don't pay for the maintenance on the building because Walgreens pay for it. You don't pay for the insurance on the building because Walgreens pays for it. It's all built into a triple net property. There are triple net properties you can exchange to all over the country. You don't have to even go see them because the corporate office sends you your paycheck every single month, even if they shut the asset down. So the bottom line is there's lots of opportunities out there to do 1031 exchanges. And let me just go to the last slide so we can end it because we said an half today. Oops, and there it was, and I just passed it, and there it is. You can send me an email to philatwan@gmail.com. It's on my business card, but I put it up here for your convenience. If you want to take a picture of it, and I'll be happy to provide marketing letters that we just discussed for you to start contacting these investors, or I could hook you up with Michael, who was speaking earlier today about the opportunity zones. That's my phone number. I just hope this was helpful to you today to rethink 2021. The key to 2021 is going to be you're getting to meet new people, you're getting to new people, and with ideas that will help them make more money, at least in the investment area. Is there anything I can answer or anything I can do before we sign off today? But I just so appreciate you all and inviting me again. I feel so honored to be a guest here at West San Gabriel Valley Association of Realtors. And I'm a member here too. And I'm not a member of every single real estate association, I can tell you that. But this one, I'm happy to come back to and speak to all the time. Anything I can do to help today, or are we done?
Thank you so much, Phil. I don't think there are any questions in the chat box. So thank you for the informative presentation. And Pauline, back to you.
Thank you. Thank you so much, Phil, Mike, Jenny, and for this wonderful section. We thank you for your expertise and valuable information today. What a wonderful noontime, spend time with you, and you give us so fruitful information. If you have any further questions, please contact to Phil and Mike directly. On behalf of Western Gabriel Valley Realtors, we would like to thank Mr. Phil Atwan, Exchange Resources Incorporation, and Mr. Mike Hardy, Cyrus OZ Funds, for your informative presentation today. We hope to see you in person soon. A quick reminder for next Tuesday, we have a class, April 28th, 11 o'clock, Home Hardings and NHD by Chris Wood and John Wax from SNAP NHD. And next Wednesday at noon 12, we have Top Producers Panel. It's co-hosted by YPN and Education Committee. And we want to thank again Phil, Mike, Jenny, Fang, and all of you joining today's class. Stay safe, happy, and we'll see you next Tuesday at 11 o'clock. Thank you.
Thanks, everyone. Have a good day.